I'm Daniel Kertcher, CEO and founder of Trading Pursuits, and welcome to the monthly market review for July 2012. And before I get started, just a couple of quick little disclaimer points I need to share with you. Number one, what I'm sharing with you today is what we call general advice. It's not individual specific advice. Number two, we haven't taken into consideration your personal financial objectives. Number three, trading involves risks. You must understand, of course, the risks you take before you start to trade. And finally, our company, Trading Pursuits, we hold an Australian Financial Services license. Okay, now, quickly what I want to share with you is a recap of what's been going on in the market for the last couple of weeks. Now, number one, what we can see here is that the U.S. initial jobless claims have been falling quite markedly. In fact, the recent announcement, just came out a couple of days ago, was far below analysts' expectations. So what this means is people who are applying for initial jobless benefits in America, the number of people that have been applying for that has fallen to the lowest level in many, many years now, since back before 2008. So this is a very positive sign. It's also particularly positive because it's less people applying for jobless benefits than what analysts expected. About 22,000 people less expected for the week-on-week period. So that's a really good sign for the economy, showing that the rate of unemployment is improving in America. Now, coupled with this is also the earnings season. Every 3 months, public companies need to make their profit and loss announcements. And the latest announcements have again been very good. We've seen a regular, consistent, improving trend of profits coming out of the top 500 companies in America, and this latest round has continued that particular trend. What we can particularly see in this particular graph is that the amount of surprises, that is the amount of profits that have exceeded analyst expectations, has been quite high. In fact, over 3.7% more earnings surprises for the companies that have posted their earnings so far. This is a really good sign. Now, it's still early days. There's only been about 20% of companies that have made their earnings announcements so far. Within the next couple of days and weeks, the rest of the companies will make their announcements. But usually by the time we have 20% of the companies who have made their announcements, it generally shows a good trend for the rest of them. At the same time, over in Europe, the European credit crisis, there's been no flare-up in fear. In fact, if anything, we can see in this graph that the Greek 10-year bond yields has actually been falling quite steadily in the last month. This basically means that Greece has to pay less interest to borrow money to keep their business, to keep their country going. So this again is a positive sign. When we have seen the problems in Europe flare up and the media jump all over it, it's usually because the interest rate yields have been rising, meaning that Greece and other countries like Spain and Portugal have had to pay more interest in order to entice investors to invest and buy their bonds. The fact that the interest rate yields are falling demonstrate that there is a better sign for Europe. So it's a combination of things that we've seen in the last couple of weeks. That is lower U.S. employment, jobless claims, improving stock market earnings, and less fear coming out of Europe. All this is combined to create a surge in the value of the S&P 500. This is the value of the top 500 companies in America squished together into one averaged out price. And we can see that just in the last 2-3 weeks alone, the value of the top 500 companies in America have collectively surged by about 8.5%. So obviously that's a very bullish sign for investors right now in the market. Now, despite this good news coming out of the markets, U.S. unemployment, though it's falling, is still quite high. It's still over the 8% mark. And really, the U.S. Federal Reserve, the U.S. government would like to see U.S. unemployment down around the 4 to 5%. That's generally considered maximum employment. You never get an unemployment figure down around 1 or 2%. There's always around about 4 or 5% of the population at an unemployed status. So that's the target. Up around 8% is still quite high. And so recently, Ben Bernanke, of the chairman of the Federal Reserve, recently announced that there's still a lot of options available to the Federal Reserve in America to increase stimulus of the economy. So they're certainly not ruling out another quantitative easing. That's big words to mean money printing. So they're looking at another potential program to print more cash and inject it into the U.S. money supply in an effort to try to stimulate the economy. He hasn't specifically said that that's what they're going to do, but he's also intimated that that option is still on the table. Another option is to, of course, keep interest rates very low. American interest rates continue to hover around the 0.25% range. And so that, again, is helping to stimulate the economy. What this basically means is that that stimulus of low interest rates and potentially more money printing will likely continue for at least the next 3 to 6 months. So over the next couple of weeks and the next probably 1 or 2 months, we'll want to keep a close eye listening to what the Federal Reserve has to say, because they may well come out with another quantitative easing or money printing program very soon. Now, this has helped drive U.S. government bond prices to all-time record highs. Despite the good news that's coming out with earnings, less fear out of Europe, the improving unemployment figures, there's still a lot of fear, and as a consequence, there is so much money pushed up into bonds, basically as a safe haven. What has happened now is the safe haven has become extremely crowded. Pretty much everybody who wants to be in bonds is probably in bonds right now. And we've seen bonds surge in the American market, possibly over the potential likelihood of another quantitative easing program, which will also help push up bond prices. Now, another reason that bond prices may have risen recently is that there's been continued U.S. sanctions against Iran, and America is actually increasing the pressure now on Iran, particularly in their oil exports. And what we can see is that the OPEC oil production output, specifically for Iran, has dropped markedly in the last couple of weeks. What this means is Iran is now producing about half, or exporting about half, of the amount of oil than they were doing just a few months ago. So America is putting pressure on specifically Iran, and this has helped drive the oil price, the crude oil price, back up from its lows from about a week ago. Oil now, after hitting around with the $85 mark, is now trading up around $90. And that's still low considering where it was last year, up around the 120, 130, 140 mark, and certainly very low against the 148 mark it was back in 2008. However, we can see a trend rising now of rising oil prices. This has also caused the other commodity prices to rise as well. Here we can see a diversified commodity fund. This particular graph is a combination of different commodities, specifically oil, gold, silver, aluminium, soybeans, agricultural products, copper, right? A whole range of different commodities squished together into one index or one averaged out price. And what we can see is, again, along with oil, the overall commodity market has surged a lot just in the last couple of weeks. Now, Australia, being the biggest commodity-based nation in the world, when commodity prices rise, we tend to see the Australian dollar rise as well. And that certainly hasn't disappointed either. The Australian dollar, after hitting around 98 cents a few weeks ago, has now bounced back up to about 103, 104 against the US dollar. Now, the expectation for an interest rate drop down to about 3.25% by the Reserve Bank of Australia is sitting around about 47% right now. So there's an expectation that the interest rate will drop is less than 50-50. And this is calculated by studying the futures prices for interest rates being traded by major banks. So essentially, there's about a 50-50 chance that in a couple of weeks' time, on the first Tuesday of the month, next month, August, that we're going to have an interest rate drop in Australia down to 3.25%. That's still, of course, the highest interest rate of all the major developed nations. But our high dollar has continued to hurt the Australian economy in terms of manufacturing and tourism. So despite the strong dollar in Australia, the value of the ASX 200, this is the top 200 companies in Australia, continues to basically track along sideways. So in order to see some real growth in the Australian market, we'd like to see some rising commodity prices, which is happening, but also a drop in the value of the Australian dollar, or a drop in the value of the Australian interest rates. What's going to happen? We'll see over the next few weeks. But for now, essentially, just to recap, we've got relative stable fear levels coming out of Europe right now. Nothing's flared up. We have excellent earnings coming out of the United States. Jobless claims are falling. Unemployment is falling in America, but bonds continue to be strong. Down here in Australia, Aussie dollar is strong, but that's hurting our exports and our manufacturing and our tourism industry, so that's holding back the performance of the Australian stock market. So for now, it seems that things aren't falling around the world. The market's fairly neutral and potentially coming back into a bullish phase over the next few weeks. I hope you enjoyed this program with me today. My name, of course, is Daniel Kertcher, and I look forward to future events with you. Good night.